bluebird, here to stay is the new bird. To sing a love song, we stroll along, walking in the winter wonderland.
All right. Again, good afternoon. Welcome to another Actima Fast Track webinar. We're going to get started in just a few minutes. Thank you for your patience. I have 2 o'clock Eastern. Going to wait a few more minutes, then we'll get started.
By the fire, to face unafraid the plans that we made, walking in a winter wonderland. In the meadow we can build a snowman. We'll pretend that he's Parson Brown. He'll say, are you married? We'll say no, man, but you can do the job when you're in town. Later on, we'll conspire as we dream.
All right, good afternoon, everyone. We'll go and get started. Again, apologize for some technical difficulties. Apparently, our Spotify account thought it was around the holiday season. It is not. It is still very much the spring. But again, good afternoon and welcome to another Fast Track webinar. My name is Peter Benjamin. Today's session is going to be great. It's one of our favorite topics to discuss. We also have one of our favorite experts here. She's going to impart some valuable words of wisdom and perhaps teach us a thing or two about, again, one of our favorite topics, LO comp. Before we dive in, just a few housekeeping items. First one, this session is being recorded and will be posted to our website at a later date. The second item is I will be monitoring the chat. Feel free to ask questions and I'll do my best to weave them in. Again, this is one of our favorite topics. We love having discussions at our in-person event. I highly encourage you to use the chat and I will, again, do my best to feed them to our expert. And I guess the final thing I want to say is that this year has been absolutely amazing. Over here at Actima, we've done our best to provide you with everything that you need to navigate today's market, from our amazing first two in-person events. And I tell you what, they were truly extraordinary. To the expansion of our Insight newsletter, to the rollout of Actima's Young Professional Network, we've been doing our best to work hard for you to bring you content and experience that the best we could possibly muster. Next week, we're in the Denver area for our second Viewpoint Regional Summit. And in June, we'll be in Louisville, Kentucky for our second workshop. The first summit and the first workshop, both truly inspiring, truly amazing. Focusing on Denver, we know it's next week, but we hope you can make it. It's not too late. There's still time to register. And again, we hope to see you at one of our upcoming events. I guess the last thing I have from a housekeeping item is a quick disclaimer. The views and opinions expressed during this webinar do not necessarily reflect the views or positions of Actima, its board of directors, its management staff, or its members. The webinar and its materials are presented as a set of ideas and possible strategies regarding its specific topic and does not represent the endorsements of either the presenters, their firms, or the concepts they present. Okay, I think that's it for now. Today's webinar is being brought to you by Mortgage Flex. Joining us today is John McRae, Senior Vice President of Business Development. John, how you doing?
Afternoon, Peter. Thank you to the entire Actima team for having us today. We appreciate it.
I know really the gratitude is all ours, but welcome. It's really good to see you, and again, thanks for being here. Now, John, I don't know if it's the algorithm or if you guys are just rocking it, but Mortgage Flex seems to be popping up in my social feeds, all over my emails, my daily periodicals a lot lately. And when I say a lot, I mean a lot. And I think that's pretty awesome. This has truly given me an opportunity to really get a sense for Mortgage Flex's drive to be a leading provider of mortgage technology, which again is fantastic. But if you could share with the group, how is Mortgage Flex different?
Sure. Thank you, Peter. We realize that, especially in today's market, there's a lot of different kind of lending needs that we see presented by our customers and potential customers. So as a result, we've moved into all facets of lending, whether it's straight conventional HELOCs, seconds, piggybacks, chattel lending, which is becoming really important amongst our credit union base as well for manufactured homes that are not HUD approved, and also consumer lending. So we couple all that in with servicing. So we also support that on our servicing product as well.
That's great.
And the origination side, of course.
That's awesome. That's awesome. Now, you listed out several things, and again, I think the things that you're doing over at Mortgage Flex are truly amazing. Looking at the company and looking at, your time there, what's the vision? Where does Mortgage Flex plan to go next? Where are you going to take this?
Sure, thank you. So we envision one technology stack for the entire life of the transaction. Today, most of the lenders out there today are dealing with different origination systems, different point of sale systems, different servicing platforms. We envision everything to be one. It's all on one technology stack. Cross training can be done so that you servicing folks and origination folks are on similar looking platform, all in one ecosystem. The ability to have organic portfolio protection where I'm logging in the system, I instantly can apply for a new loan, launches my servicing data over to the origination point of sale system.
Okay, that's awesome. So you mentioned servicing, right? You mentioned you have your LOS and your servicing platform. Why the new servicing offering in the market? Let's just go with that. Why a new servicing offering in this market?
We all see a lot of capital spending and investment in venture capital money pour into the origination side. We don't see that much on the servicing side whatsoever. In fact, most of the platforms that primarily all loans in the United States are serviced on are approaching 60 years old. So we thought it was an ample opportunity for us to really jump into the space, invest heavily, provide modern web-based, cloud-based solutions. You can access the servicing system from anywhere on a phone. So a lot easier than a lot of the old mainframe platforms that are out there today. And from a costing standpoint as well, much more cost effective.
Okay. Now, bear in mind, I think Mortgage Flex is fantastic. I haven't, even when I was on the lender side, I didn't go through this process with you. I wasn't fortunate enough to have a new LOS implementation or a new servicing platform implementation during my time on the lending side. But I hear rumors that you guys do pricing and contracts slightly different, and the people who I've heard from, really enjoy that part of the process, which is weird to say, because who enjoys negotiations and who enjoys contracts, the contract portion. So why is your approach to that, getting some buzz?
We really want to be a true partner so that our lenders want to work with us, and not because they have to work with us because they're tied into long-term contracts. And we're hearing a lot from lenders today that they're really in difficult positions because they're on contracts that really protect the vendor from a price standpoint and don't work with the lenders when the volumes are down. And so we really work on providing short-term contracts, extremely low minimums. Anybody can walk away if they're not happy with us. And so that way you're not tied to a bad contract that affects your business negatively.
That's awesome. That's refreshing. That's really refreshing. So now I understand why there's such positive buzz about Mortgage Flex. That's awesome. Well, John, thank you again. I truly appreciate your time today, and thank you again for sponsoring today's session.
Thank you, Peter. Thanks for having us.
Okay, awesome. Turning our attention to our subject matter expert, I couldn't be more excited to introduce a longtime friend of Acuma, Chris Cully, a partner for Mayor Brown in Washington, D.C., who specializes in consumer financial service compliance issues. Chris, how are you doing today? It's great having you here.
Thanks so much for having me. Thanks to Acuma. Thanks to Mortgage Flex. I'm happy to join you today. Thanks.
Of course. Now, Chris, if it's okay, before we dive in, I'd like to share a quick background as to why we selected this topic for today's webinar. Is that okay?
Yeah.
Okay, awesome. Sorry. So I mentioned it earlier. And so really, besides the fact that LO comp seems to be one of those topics that we just can't get enough of, I want to say roughly about a month ago, the CFPB initiated a review of the MLO rules under Section 610 of the Regulatory Flexibility Act. That's a mouthful. This review will look at whether the rule is too complex, duplicative, burdensome, et cetera, et cetera, et cetera. Now, there are several sections, subsections, provisions, whatever you want to call them, included in this review. But one jumped out to me. One jumped out. Now, it was the section connected to transaction-based compensation and dual compensation to mortgage originators. Specifically, the one that prohibited the steering practices and financial credit insurance and loan originator qualification, background, and training requirements. All of that. Okay, so this one rule jumped out to me. Now, Chris, it's been just over 10 years since the rule was issued. This seems to be a topic that continues to be discussed. To expand on that, since I've been part of the association, been part of Acuma, you've been kind enough to take part in several conversations on this topic. I can think of maybe 6 or 7 in the past year that you've taken part on this topic. Now, I think it's great because this is one of those, this, I'm gonna side note this, but this topic, whenever I go to an in-person event, and whenever this topic is part of a roundtable discussion, it doesn't even have to be a roundtable discussion. It can just be a session at an in-person event. There is a lot of discussion around this, a lot. I mean, people are asking a lot of good questions. People ask, provide feedback. I mean, if you just listened in on this, you could walk away with a pretty solid comp plan at any of our events. But so let's come to the questions. Let's go through these lines of questions. So, in your opinion, in your mind, what is it about this topic that continues to cause so much confusion? Because I don't want to use the word confusion and make it sound extreme, but we ask a lot of questions because we still don't understand, right?
Right. Well,
Does it boil down to just gaps in information and lack of training, or is there something more simple than that?
yeah, well, I'm not really sure what what is so particularly prickly about this topic, but I have some guesses. I mean, first of all, for many mortgage lenders, this rule and this prohibition against a lot of the compensation practices we relied on, it's a full-scale change in the way that we really run and finance our mortgage businesses. So the fact that a loan originator's compensation can't be affected, it can't be reduced, even if the loan originator makes a mistake or wants to share some of the comp in order to, kind of beat competition. I mean, all of that, I guess, was just a huge sea change to the way things used to work. And in a sense, with this rule, there wasn't really a drop dead deadline. So, I mean, there was an effective date. We all knew when that happened. But like with TRID and our new loan estimates and closing disclosures, we all had to adjust. We all had to make changes. We had to flip that switch. Right. Similar with HMDA, there were some big changes in HMDA, but we had a date by which we had to get it right, and we had to change the way we collected and reported that data. But with this LO comp issue, again, we know that it became effective, but there was no real drop dead feeling about it. Some of us haven't been examined on this issue. It's been somewhat quiet on the enforcement front, even across changes in administration since the rule became effective. So with all the issues we absolutely have to deal with on an immediate drop dead basis, maybe this just wasn't one of those issues. And it's certainly true that market changes breed creativity here, or at least questions. So you may all be hearing about the lender down the street who is doing something with their compensation that you may have thought was prohibited. So the questions keep coming up. I mean, production is low, so everybody's getting a little bit creative and new questions are arising. So maybe that's really what keeps this regulation on the top of our minds.
I like how you brought up TRID and HMDA, right? For all intents and purposes, TRID and HMDA were two changes to our industry. And I would say, and I would easily argue that TRID was was probably the one that had the highest impact to our industry. Okay. HMDA 2017, yeah, it was a lot of data points, didn't have as large of an impact, right? But so from an implementation standpoint, TRID and HMDA, you're right. We had the time to get things right, and with this, we didn't. Now, if they and as we think about that TRID and HMDA and how the agency went about and implemented TRID and HMDA, and they allowed a period to get it right. With this review, do you foresee them kind of giving us that transition period where we possibly could make the corrections? Do you see them providing more clear and concise guidance, which I know, talking about the agency in question, clear and concise doesn't exactly go along with it, but do you see that type of a possible transition period at all with this?
Well, obviously it's hard to say. A cynic, which maybe I am, could say that like this effort is going to result in absolutely no changes from a regulatory standpoint whatsoever. So, I mean, it's true that the agency has gone out and said, tell us what you think about this rule. But from a real legal standpoint, you mentioned section 6 whatever of the Regulatory Flexibility 610. What that really requires the agency to do is a pretty narrow effort. So when an agency issues a rule that the agency determines may have a significant impact on small entities, it has to do all kinds of analyses and issue those analyses for public comment. It did that when it initially issued this rulemaking. And then the statute requires the agency to go back 10 years later and take a look at it. So as a real technical matter, the only thing the agency really has to do right now is think about the ways in which the rule is particularly burdensome on small entities. So it could, and I mean, one thing I will say is that there are a lot of small entities in this industry. I mean, we're talking about credit unions with $850 million in total assets or less. That's a lot of credit unions. It's a lot of other entities. Mortgage brokers, a lot of mortgage broker companies are small entities. So there are a lot of participants to think about. But what the agency is interested in is the extent to which their rulemaking affects those entities differently than, or in a bigger way than the big players out there. And so it's possible that they can say, yeah, we looked at it, nah, we're good. I hope that they don't take that, because I do think there are ways to improve the rule. And again, the only thing they're really looking at is the effect of their regulation. So the statute says no loan term based compensation. So that's not really on the table here. They're not going to go back on that. The statute told them to do it. But some of the things that with the
exception to loan amount, right? I mean, that's the one loan term item that compensation is allowed to be based off. That's like, but anything else, no, correct?
Right. So the agency came up with a lot of gloss on that principle. So even the definition of what a loan originator is, as we've seen, that's pretty broad. It's kind of anybody who is, referring a consumer and talking about loan terms, all the stuff about profits from a mortgage business. So the thought that profit-based bonuses are prohibited because they think that's based on multiple loans by multiple originators. So they'll look at all those things and try to discern whether those aspects of the rule are having a disparate effect on small businesses as compared to large businesses. So,
Right, but you use an example, right, where let's say certain loan types, and it's just a general statement, certain loan types, and it's known, certain loan types make a mortgage company, make a credit union more money. It is what it is, right?
Yeah.
Now, you have to be concerned about fair lending when it comes to that type of steering, right? Where paying someone based off of that type of loan type could have a negative impact on that consumer in more ways than we know. And then when we start thinking of all the different regulations that possibly could tie to this, I mean, we already mentioned TRID. Okay, well, there's a transfer tax, disclosure rule. That's if you screw up on transfer taxes, there's nothing we can do. I think at our last summit, I told a story where I had a situation where a loan officer had a property that was titled as a corporation, but they wanted to refinance as a consumer. So we had to take it out of the corporation, put it in his name, and then put it back in the S Corp's name. The amount of transfer taxes that were not disclosed, there was nothing I could do. Right. But at the same exact time, so that's how TRID ties into this. But coming back, there's fair lending, there's steering. I mean, you don't see them changing that stuff, right? I mean, it's still there to protect the consumer, not so much what the loan officer wants, right?
right. And you do make a good point. And so a lot of comments have already been submitted to the agency on this. And a lot of what they're saying is, number one, there were a ton of rules that came out of the Dodd-Frank Act, a lot of which have really cleaned up some of the practices that led to the financial crisis. Certainly, this loan originator compensation rule was one of them, but, TRID has been cleared up. All of these, the LO's compensation is disclosed there. It's very transparent. That was one of the things that the CFPB and the Federal Reserve before it were really concerned about, is these folks get paid. It's not transparent. Consumers don't know to shop on these issues. But now a lot of that has been cleared up. And as you say, we're subject to fair lending laws. So, so some of those, that kind of discipline has already been instilled through other means. And then if your loan originator misdiscloses the transfer tax, maybe that should be on the loan originator and it shouldn't be put on the credit union, especially if this loan originator just can't seem to do it right. So I know that's something that the CFPB has heard a lot about, particularly in connection with this rule. And in a sense, it does go to small entities, because it's harder for a small credit union to sort of absorb those costs than it is for some of these huge financial institutions to absorb. So hopefully that's something the CFPB could be convinced to address.
So, all right, so let's pivot to a different direction. You kind of hinted at it, and no one's perfect. There's no comp plan that's out there that's perfect, right? I'm sure there are some that are pretty darn close, but you work with several different types of lenders, credit unions, non-bank lenders, banks, community banks, you name it. You work with several different types. So, again, in your opinion, and really focusing on the mortgage industry as a whole, and I guess if we really want to, kind of whittle it down to just credit unions, and based with conversations that you have, what are we still misunderstanding? What are some of the items that we just can't seem to get right? What are some of those items in the comp plans that you review that you're like, I highly advise you don't do this?
Well, and I have seen a broad range. Some lenders, some credit unions decide that they are just going to have simple plans. I mean, we all know that you can compensate your loan originators based on a fixed percentage of the loan amount. Some of them are just unwilling to get, riskier than that. And that's great. I think one of the things that a lot of folks just can't quite seem to understand, and it makes a lot of sense, is some loans are just harder to originate. Sometimes it's a government loan, or, sometimes FHA loans are really trickier, or some of the other government loan programs. And how come I can't pay differently for those? Because they're harder and they take more time. And the thing that's frustrating is the CFPB doesn't recognize that part of it at all. They say, well, if you want to pay your loan officers by the hour, you're welcome to do that. That's perfectly fine. And that way they get paid more essentially for harder loans. But you can't do it that way otherwise. You can't just decide that this loan is hard, so we're going to pay you differently for this type of loan, because the CFPB has said that loan products are a bundle of loan terms and you can't base compensation on loan products. So
that's interesting, right? Because we've talked about this. You and I have talked about this in the past. That's tough, especially for a smaller credit union, right? To just keep it simple, right? There's especially when on what a credit union thinks is the fair value for loan officer compensation. Thinking back to 2017, I have the numbers right here where the average national basis points was 110, right? Just above 110. In the Q2 24, sorry, in Q4 2022, the average basis point was 115. I mean, that's a lot, right?
right.
In one sense, I can understand that for FHA. I can understand that for maybe a super jumbo or maybe even a self-employed borrower. I can understand that, right? Those are inherently more difficult loans. But for a loan that's true vanilla, 760 FICO, 60 LTV, not a first-time home buyer, there happens to be an AVM in there where the loan officer is literally just rubber stamping it and moving it on. I mean, that's absolutely insane. But also you mentioned, okay, well, if you don't want to do that, if you don't want to have to worry about, that program, pay them hourly. Well, paying them hourly, that opens up a completely separate different can of worms.
Right.
Okay, now we have overtime. Okay, well, how do we get them exempt? Do they qualify for was a highly compensated person? Well, in order for that caveat to work, they have to have a sense of authority, right? Like they have to make a credit decision in some way, shape, or form, right? So whole bunch of different cans of worms right here.
That's right. And I'll remind you that those issues, even if you're paying commissions, you still have to be cognizant of the extent to which the loan officers are highly compensated or outside sales. And so overtime is definitely a looming issue over all of this.
So all right, so to that point, so how do we navigate that overtime standpoint? Because I think that tends to be a question that pops up a lot at our events. Overtime, no overtime. I kind of said highly compensated, but there's that caveat of needing to make some type of credit authority or independent thinking, if it was. Are you still seeing that? How do we navigate around that? Because that's a completely different set of laws.
The different set of laws, and a bit scary to a certain degree, because you've got this federal law, then you've got, depending on how many states you've got loan officers in, you've got to comply with the state wage and hour laws too. But so as you mentioned, yeah, I am getting a lot of comments, a lot of questions. Credit unions and others are spending a lot of money on overtime, and wondering whether they really need to do that, because the person down the street, the loan officer, they just have applying for a new job, says that they didn't have to do that at their prior shop, because they were treated as an outside salesperson or otherwise were treated as exempt from all of this stuff. And I do think that there are, depending on the state, there are some ways that a typical loan officer may be exempt from these requirements, but I just urge you to look at it very carefully. For instance, and forgive me, I know you've all heard this before, but I know a lot of lenders rely on the outside sales exemption because, especially after COVID, nobody's coming into the office. Everybody's out, working from home, working, remotely. That seems to be the definition of outside sales, because they're not coming into the office. But I would just encourage you to take a look at those exemptions very carefully, because that, for instance, doesn't apply to folks who are spending most of their time working at their home office. It really is intended for somebody who's regularly and customarily, out and about and away from the office. So it can be, it can be expensive either way. Sometimes you're paying money for overtime, but you would hate also to be caught paying a lot of money after you've been sued or brought to task by the Department of Labor. So, and I keep going on and on about this, but in these sort of low production times, it seems that some of our loan officers can get grumpier than they might usually have been. And so they're going from place to place. The grass is always greener, and they're just not making the money that they used to make, and so they're looking for someone to point the finger at. And so I have heard about a lot of former employees that have pointed their finger back at their mortgage lender employer and saying, "You should have paid me more. You should have paid me overtime."
So what else? What are some of the other items that we just can't seem to kind of get right? You talked about. I'm gonna use a phrase. It's not necessarily the phrase that's in the regulation, but clawbacks. Are you still seeing that, or are we doing that? I mean, admittedly, when I did it. Admittedly, I did it. You please forgive me. I never had to execute upon it, but we had a provision within the agreement that we were going to do it. We were a small credit union, we had to do it. Are you seeing it out there?
Yeah, I see a lot of clawback provisions in the comp plans, and I haven't seen, the CFPB or other regulators really provide a lot of guidance and say that, no, you can't do it that way. I mean, I urge caution, because anytime that you're deciding not to pay the compensation, or to kind of claw back that compensation for any given loan, you're kind of raising the risk that, number one, it's going to be scrutinized when your examiner comes in, and number two, that they're going to see that as some sort of manipulation of the loan officer's compensation. Now, I can argue that it's perfectly fine, and as you say, Peter, I see it in nearly every compensation agreement that I've looked at. So it's definitely not something that you would be an outlier if you were doing it. But I do urge caution, and just make sure that it's not a way for you to try to clawback compensation because of the particular terms of the loan, or to the extent that it really relates to a loan officer's mistakes. I mean, I hope the CFPB fixes this, but there really is a limited ability to fix mistakes through compensation.
Yeah, but even to that point, let's say, and hypothetically, let's say they fix that. Right. Let's say they allow for the clawbacks. Again, let's say they allow it. Do you see them going back and possibly revising TRID to allow a greater tolerance in some of these fees? Or is that the next step in this? Because having, and I always butcher this, no over zero, but
right,
no tolerance, right? That's the tough part, right? So that's the next thing that any industry association or any industry trade groups want to focus on. Okay, well, now you're gonna allow us to claw back. Well, now we need to get transfer taxes removed from TRID as a no tolerance item, right? That's the next step. That's the next part of the evolution. All right, so I guess, go ahead, please.
No, I was just going to say, wouldn't that be nice? I think that's unlikely. Perhaps there's a chance that they'll allow us to kind of ding our loan officers for mistakes to it, and we can do that now to a certain degree if it's unforeseen, but less so for just kind of boneheaded mistakes. But I don't know that that there's any appetite to really trim back those tolerances under TRID. I think
But I mean, don't get me wrong. The last thing I want is to have another conversation about TRID implementation. That's literally the last thing I want to do. But if it was for the better, okay, maybe I'll get it. Maybe I'll get it.
yeah, I think it's unlikely. I think the CFPB for its part thinks at least that TRID is working well and that all the costs have been absorbed in a sense. And so there's a possibility that they could tweak that part of the LO comp rule, but I don't see them going to back to TRID for anything other than just simple clarifications. I think those tolerances are here to stay. So
Okay. So, going back to, one of the things that they're looking at is, again, compensation based off of loan terms, right? And so when we look at a loan term, right, we are looking at a first mortgage, right? Are we also looking at, in that loan term, product type? So for example, and you already said it, a conventional Fannie Freddie versus FHA, right? But then what about, new construction always tends to be like that
Right.
one that's always left out, right?
Right.
New construction, first mortgage, doesn't matter if it's, or even renovation type loans, like a 203K or a construction loan that's a portfolio product, that always seems to be left out. But then we also have second trust, right? I mean, how are we, so are they looking at that stack of loan products? Is that included in terms? Walk us through that.
Yeah, I think they're looking at it in going through the comments. So the comment period closed, I think, last week, and they got about 268 comments on the rule. And a lot of the comments are from individual mortgage brokers who just said, this rule is hard on me and I dislike it, and I do good service for my consumers. And certainly they do. But some of the comments did address things like construction loans, because some of those are a to close loan process. And so are they having to pay twice for those? How are we supposed to pay our loan originators on those? First of all, they take skilled loan originators to do. It takes them a long time. There's really no possibility for steering here. So, why can't you give us some leeway? And so I wouldn't be surprised if the CFPB, provided some guidance on how exactly to address construction loans, construction to perm loans, and giving us a little bit more guidance on how we can do it. But one thing that I think is really hard to understand about the LO comp rule is it's supposed to be an anti-steering provision, right? You're trying to get the loan officers to not be incentivized to steer. Well, when you're talking about construction loans, that's just not really an issue. But the thing that I think is frustrating about the LO comp rule is it doesn't always depend on whether or not there actually is this ability to steer a borrower from one loan product type to another. It really is this based on loan terms, regardless of whether any sane loan officer would try to steer, a borrower into a construction loan. So that's another thing that's pretty frustrating, but perhaps we can be hopeful for, at least in connection with construction loans. You mentioned second lien loans. I know that there are some lenders who are trying to figure out whether they have to pay, if they pay based on units, like for every loan you originate, we give you X $100. Do they have to count that simultaneous second lien as another unit? And, that's something that I think has been kind of painful to swallow when, as you say, it's just all, it's all tied up in that first loan origination. So why should you have to pay for a separate unit for that second? And, the easy answer is, well, you can't pay differently based on lien position, but perhaps the CFPB will be convinced to address that.
Right, but so you can't pay differently based off lien position, but home, you will say the second mortgages, home equity and the home equity loans, they can have a different basis point structure or flat rate other than first mortgages, right?
Well, I would tell you that I'm not really sure, because why should you be able to pay differently what if I get a larger first lien cash out refi as opposed to getting a first and a second? Should the loan officer be able to kind of steer the borrower in between those two different financing options? So yeah, I think it's unclear, and I think it's a little bit, I think it could be a little bit risky depending on how you compensate. If you just compensate on kind of the loan amount, whether it's a bigger first or a smaller first with a second, and the total loan amount is the same, you don't really run into that problem. But if you are paying based on the number of loans, I think you could be risking something if you pay differently for those two scenarios.
Okay, so basing it off of basis points on the loan amount, safe bet.
Yeah.
That's it.
Yeah.
Okay. All right. Just I'm looking at the clock. So let's start looking ahead. Part of the 10-year review process allows for an open comment period, which just closed. I'm not sure whether or not you submitted comments, and if you did, fantastic. Thank you very much. Again, the comment period is there to suggest how the CFPB could improve the rule. We always urge credit unions, whenever there's an open comment period, to provide feedback. But here's the question. If you had a crystal ball, actually not so much a crystal ball, but what would you like to see come out of this review process? And you hinted at it several times, but are there certain parts of this rule that really need to be changed?
Yeah, and I have hinted at a few things. Like I do think that particularly for smaller mortgage lenders and mortgage brokers, like many of our credit unions, it is tough to shoulder the burden of an LO that is trying to make the deal work because the person down the street is offering a price break, or is trying to make the deal work but blew it on on disclosing a transfer tax or something. I would argue there's no harm to the consumer in allowing the loan officer to, concede some of their compensation under those circumstances. I would also really like to see the CFPB address some of these special housing finance agency programs or special purpose credit programs. The credit unions are not making any margins on some of those, but they're very important products that are there because they're considered safe products for the consumer. They're targeted. They're going to help the communities. They're going to help the borrowers. So I really hope that the CFPB will take this opportunity to allow an exception from the rule for those special programs. They allow the exception under certain other regulations, like the ability to repay regulations. Some of those special programs are just exempted. So I really think that there's room for the CFPB to allow that under the LO comp rule as well.
Okay. Now, from a timeline standpoint, do you see anything happening as far as change before the next election?
Yes, I think they will try to get a lot of things out before the next election. He's a busy director. He has his goals and priorities. So I do think we can look forward to at least some answers on this and a number of other issues before the election. Then there'll be a period of time that I hope we can bring into compliance, so like a delayed effective date. But yeah, I think that we can see crystal ball. I think we'll see some pretty fast movement on this and a few of the other things that the CFPB has thrown out recently.
They've thrown out a lot.
Yeah, small business data collection and some of the other things that they're after. I think we'll see some movement in the next few months on all those issues.
Okay, awesome, Chris. We are approaching time. But before we wrap up, and before I let you go, any final words?
No, I'm happy to talk about these issues again. I think that, I think that perhaps this will start to take care of itself a little bit, but I can't really tell you why this issue is still so, so kind of bothersome for everyone. But I'm certainly always happy to answer questions about it, and especially like hearing lots of creative ideas. So
The creative ideas is what keeps us going, right?
yeah, that's right.
Okay, awesome, Chris. Well, Chris, thank you for spending time with us. I look forward to catching up with you at a future Acumen event.
Yeah, thank you so much for having me.
Absolutely. Once again, thank you to John McCrae and Mortgage Flex for sponsoring today's webinar, and again to Chris Cully for her valuable insight. And also to all of you, thank you for attending today's webinar. Your time is valuable, and we appreciate you spending the better part of an hour with us today. We hope that you enjoyed today's session. And finally, don't forget to check out acumen.org and our community page for all the latest updates on our in-person events. Other than that, everyone, have a great day. We'll see you next time. Bye.